Hey everybody, it's Pete. Good morning. Welcome to a new episode of Stocks for Breakfast. And today we're going to talk about the mindset of how winning traders think and some of the common obstacles that hardworking, super smart, really chart reading, hardworking people have who can't make money. We're going to get past the obstacles today. We're going to talk about what probability is. We're going to talk about leverage. We're going to talk about risk, how those pieces fit together, and then why they cause stumbling blocks to stop you from achieving what you feel is just so close that you just can't get beyond that level. We have a lot of conversations in the boot camp discussing about I know everything to do, but I can't make money. And what we're going to cover today is those last steps, the frustrations, the challenges, the obstacles, the roadblocks that make you feel close, so super close, but you just can't seem to figure out what you're missing. And I have to be honest with you, a huge part of understanding how to get paid, it really comes down to learning what not to do first. It's interesting. We have a lot of people who flood into the boot camp and just can't wait to start trading without any experience, and especially not even knowing the strategy. And they're in there for like an hour and they're like, I don't understand. What am I missing? What are you missing? You just put your foot in the water. You got to learn first. Oh, my New York just came out there. You need to learn first what not to do. But the only way to learn what not to do is first you need to understand what your strategy looks like. Because it's one of the biggest revelations when somebody starts trading and learning and learning and learning and getting better at understanding order flow. I actually light up and get really happy when somebody in the boot camp says, I don't see anything. That's amazing. That's amazing because now they know what they're looking for. So we're gonna discuss probabilities. We're going to discuss strategy. We're going to touch on order flow. We're going to touch on roadblocks. We're going to talk about risk and leverage. And I actually have a little PowerPoint today. So we're actually going to get into a little bit of fancy stuff today. So we're going to share the screen. We're going to head over there, and I think you're going to see yourself in some of what we're talking about today. So core definitions that are the primary things we're going to discuss right now is probabilities, risk, and leverage. And I think what's kind of interesting is a lot of people gravitate over to risk and reward, and they're just like, I want to make 3-to-1 on this trade, and that's where I'm starting out. But the problem is they don't ever really consider what are the odds of reaching the reward for the risk you have to take. So that's what we're going to talk about today. We're going to talk about probabilities and how that affects how you think, which is, I know that kind of sounds out there. I know a lot of traders don't want to hear about trading psychology, but if you have the right mindset on a trade-by-trade basis, probabilities means everything, because then you never stress out about one trade making money, one trade losing money, making money, losing money. It doesn't matter anymore because you're literally trading for the probability, and the one trade doesn't mean anything anymore. Now it's just a question of probabilities, risk, leverage, and trade management. So we're going to discuss what that means, but I want to first start out with some very clear definitions. So everybody talks about edge. Everybody talks about you need an edge in the markets. You need an edge in the markets. But too many people separate from that conversation about edge is edge literally means over time. And this is really where like this right now, bam, you're going to be able to like, oh my God, I never thought of it that way. How many times do you ever put on a trade and like you get, your mind gets melted over, oh my God, what did I do? The trade didn't make money. The trade had a perfect entry and a perfect setup and it didn't make money. What did I do wrong? What did I miss? You didn't miss anything. That's a part of probabilities. That's the point of learning from somebody like me, learning from somebody who's been in the business for a while. It's not about the one trade. It's about your edge over time. That's the part that is just a super secret of trading that's so obvious. It's the very part of trading, but it gets forgotten as soon as you start to trade. You're like, oh my God, what did I miss? Oh my God, you didn't miss anything. Relax. It's one trade out of many. And the way we talk about it in the boot camp is over 10 trades. What'd you do over 10 trades? What did you do what you were supposed to do over 10 trades? Not a million trades, not one trade, it's 10. It's very simple. So next you have risk. And this is, again, we talked about probabilities and how that relates to risk. Now, you should only accept risk if the probability of reward is good. It sounds silly, but you think about this. How many times have you taken a trade where you said, well, I see a support level, I think I'm going to take the trade? just seeing support is not a good idea. What are the odds of it moving in your favor if support holds? Big difference, really big difference. And the last part is leverage. When you understand probability, when you understand the mindset of probability, when you understand you should only accept risk because the reward is good, which is the probability of your target being reached, only then should you consider using leverage. Only then should you consider using additional capital, because now you know how to use it. So we're going to get into what those mean right now. So understanding probabilities. Probabilities are the odds of an occurrence happening over time. Not on the one trade, not on your last trade, not on your next trade, over time, over the day, over the week, over the month, depending on how many trades you actually place. So over time or a large sample size. So I say over time because I'm assuming if you're an active trader, over time you have a sample size, but I want to get clear. If you're an active day trader, you could be making 10 trades in one day. So you're accelerating your learning curve. You're accelerating how fast you allow your edge to actually play itself out. So trading, and again, I hate to use this word, but it's so commonly confused, but they're the same. It's confused, but it's the same concept. It's not gambling, but you must understand how they're similar in the fact that it's about the edge. So every trade is your assessment of the risk you would accept for the potential reward. Every single decision. So if you see a stock making all-time highs and you're like, I'm going to short this because I want to get a good entry, no. That's a bad decision. The probability of making money over time is very small. And this is really where you got to catch yourself. You got to catch yourself. You got to catch yourself. Every single decision must be in the context of your edge. So again, shorting a double top versus buying a pullback in an obvious trend, very different scenarios. You're accepting risk in both of those instances versus having a very different probability of profit in two very different situations. So next, applying probabilities and thinking correctly. This is 100% in your control. This is the point that I want to get across, okay? There are certain scenarios that have a higher probability and the greater potential for profit. There's just no other way around it. There's certain trades that are just better than other trades. And we talk about it a lot in the boot camp, where I'll walk everybody in the room through work the order versus let's go get them. The difference is the probability of follow through, the probability of earning rewards versus the probability of getting stopped out. So this means you should risk more to earn more as you move higher towards your A+ trades. If you did not earn more on these trades, it was still the correct play, even if it lost money. Basic setups for determining trade expectation. Now we're going to walk through what it looks like for you to think it's top-down analysis, but what it's really doing is building an argument for a great idea. So I just want to touch on this. If you have an A+ idea, you go in, you confidently go in, you confidently work a little bit more share size because the odds are better. There are certain situations where it's still a good idea, but it's not perfect. So in those situations, you work the order. You go in with what we call probes, as Jesse Livermore said. You work the order. But here's how you start your top-down analysis, and you look for the foundation. Now, it's not a coincidence here. The biggest part of what I'm about to show you as a pyramid is on the bottom, because it's the foundation of the most important elements of the wind behind your back between a great trade. I'm trying to think of all the ways to word it so it sinks in. So the first is obvious order flow in the broad market, general market, sectors and stocks. So if you have a watch list like we do in the boot camp, a lot of it is all lit up at the same time. And the same color like we had yesterday. Yesterday, the market happened to be green across the board and all-time highs in many, many stocks. Order flow is now obvious in specific sectors or specific industries. So basically what I'm saying, the separation between these two, let's say the market is not obvious on the bottom, but you do notice, say, for example, all of the financials are green, or all of the energy stocks are red. So now you're getting sector-specific or industry-specific for good trading ideas, despite the fact that the market might not be obvious. Maybe that sector is in play. So you can see the difference now between everything is obvious versus one sector is obvious. You can still trade that sector, but the market's not behind you. So your conviction level and how you allocate shares to that trade idea changes a little bit. So when they're both on the same page, like we had yesterday, you can get in there and be like, wow, look at everything going, and you have a lot more conviction versus just that sector. And again, you can still trade it with conviction. It's just not the full picture. And then the last part is when you have only stock specific, where the market might be a mess, but you're like, wow, I found a pocket of opportunity in these 2 stocks and I could trade them very confidently. But again, you don't have the same trade expectation because it's just that sector. Also adding to this, now you start to add multiple time frames where you might be looking at a stock like AMAT yesterday, or a couple of these individual stocks that out of nowhere don't have order flow, didn't have stock market specific, sector specific, but that stock was on fire yesterday. It's more of a short-term trade, again, working the order a little bit more because you don't have a lot of commitment from the higher time frames and from institutions over time. So we're going to talk a little bit now about stumbling blocks, and we're going to go through these relatively quickly because nobody likes to hear about what they're not doing right? But again, these are the ideas that really sink in when you start to say, no, that's not what I'm supposed to do. The more I avoid that, the closer and closer and closer and closer you get to see your account growing consistently every month by avoiding what not to do, only allocating capital and accepting risk on great ideas. So a stumbling block is not recognizing the moving averages do not have any significance in flat markets. And this is also as well as not recognizing when your trades don't have order flow. You just trade, look, it came up on a scanner after 5 minutes. And you're like, oh my gosh, let me get into that trade. You have to recognize when order flow or the market is flat and you're basically just guessing the next move instead of waiting for the market to tip its hands. Next is a really big one, especially if you're in a chat room, especially if you're in a community, especially if you're scanning the internet for ideas, trading somebody else's ideas and trading impulsive ideas. We actually discussed this very briefly yesterday, and I don't have stats on this. It just feels personally from my own trading. When I trade somebody else's ideas, almost 90% of the time, I don't make money, which is why game planning your own ideas is where it's easier to make money because you have the conviction of you did the work. You built the argument. You made all of the reasons why you should be trading that idea, which again, when we do our game plan meeting, I rattle off a bunch of stocks and we talk about them. But once the game plan is done and we came up with all the ideas of why or why not, then you need to take the list and make them yours. You need to say, these are the 5 stocks I'm trading. We actually had somebody in the room yesterday, Jeff, who's relatively new to the community, said my 5 stocks didn't do anything, so I didn't trade. That's what you want to hear. When they're awesome and they're doing what you want them to do, you get in there and you trade. When there's nothing going on or they're not doing exactly, you have to be okay with sitting back because now you're not throwing money away and you're in cash waiting for the next good ideas. Number 3 here is being greedy when the tape is slow. And when I say the tape, I mean we're not seeing volatility. Volume is very light. We're not seeing push and a pause, and you're trying to force price action. I can tell you personally, a lot of my biggest losses come when the market's stuck tight and I feel like I have to do something. Again, something we talked about yesterday. You don't want to trade when nothing's going on. When you're the only person actively trading a stock, you're forcing it. You want to sit back and say, I'm okay. We don't get paid by the hour. We get paid by the month. Very big difference. Exiting trades that are in the gray area without a good reason. This kind of gets back to the first one there, where you are looking at a trade that is boring you, but still profitable. We had one this week where a couple of people were commenting on EAT stock and RUN, R-U-N, where they were swing trades. We initiated the trades. Everything was good. It was kind of going like this, kind of going like this, and just still moving in your favor. But you're like, oh my gosh, what's going on? No reason to exit the position. Both of them hit profit targets. Both of them were really good, consistent movers. The problem is we're like, oh my gosh, look at Apple flying. Look at Tesla flying. Look at, all these stocks with 20% moves in one day. Don't exit a trade that is still working. You have to say to yourself, what are the reasons I got into the trade? And as long as those trade reasons are still valid, hang on to that trade. So this stumbling block is you're cutting your profit short is probably another way to word that, right? Not being completely prepared, which includes getting enough rest. This is a big one. If you go to the market, what else to give you ideas, whether it's for the day, the week, the month, whatever it happens to be, and not knowing the context behind those ideas, not knowing the exact strategy behind those ideas, it's going to be challenging for you to have conviction. So you need to be prepared. And even if somebody does give you ideas, so let's say you come into the room, you come into the boot camp, I'm giving you ideas. We will explain those ideas ad nauseum until you fully understand the context of why it's a good idea. So these are all the reasons and stumbling blocks that immediately have to be acknowledged, avoided, reduced, eliminated, and then get to the point where this last part is the most obvious one: trading against clear institutional order flow. If the smart money is pushing a stock higher and pushing it higher and pushing it higher, and you're like, you know what, I'm going to try and find a top, or a stock is getting devastated after earnings, and you're like, you know what, I'm going to get in there and I'm going to get the greatest entry in the world in this stock. I understand earnings were bad and it's going down, it's going down, it's going down. I'm going to try and pick a bottom, pick a bottom, pick a bottom. Why? It's not the best trade in the world. You got all these other stocks flying higher, making all-time highs right now as I'm making this video, and you're looking to buy a stock that's getting crushed. Don't do that. God, that's such a tough way to be consistent. Which also, we're going to end on this point. A lot of traders have this thought process. I know I did when I first started trading. You're like, oh, it's going to roll over. It's going to roll over. It's going to find a bottom, and I'm going to catch the bottom. You don't need to predict the top of bottom. You don't need to predict the top to predict where anything's going. You know what's the easiest thing in the world? Find what is obvious and just piggyback that ride. By far the easiest thing in the world to do. Covered a lot here today. This is a video that you want to watch 1 or 2 times, because when you really think of the concept of probabilities over time, it eliminates all that stress of whether one trade made money, one trade lost money, one trade made money, and it doesn't matter anymore. You're looking for how did it work over time? How did it work over 10 trades, 20 trades? So now you're not nervous about entering a trade. You're not exiting a trade. You can work on always, right? You can work on profitable trades. But when you think about probabilities, it's what are the odds of my profit target being hit versus my stop loss. And when you learn to do tape reading, you stack the odds, stack the odds, stack the odds. And all of a sudden you're like, well, I don't have any good reason to be in this trade. You start to avoid them. And that's where the probabilities start to do the hard work for you, because now you know what you're looking at. And once that gets consistent, you start making money, start making money, start making money. Now you're like, you know what? I can size up a little bit now. And only then do you start to understand how and when to use leverage. Covered a lot today. This is important stuff. If you have any questions, absolutely leave me a comment, and definitely subscribe to the channel. Have a great day, everybody.